essentials of market structure. Okay, essentials of market structure. And the basic introduction is, what is market structure? What really is market structure? What is market structure? Now, at its core, market structure is very simple and easy to understand. Okay, market structure is very, very easy and simple to understand. It is a trend following to that trade free and follow based on how asset moves. Okay, it's basically like a trend following tool that traders read and follow based on how an asset moves. It's basically a trend following tool that you as a trader you can read and follow based on how an asset moves. So basically, market structure is also referred to as price action and is key to understanding how to identify what the market has been doing in the past and what it has potential to do in the future. It tells you what the markets will do. It tells you how the markets will go about it. It tells you all these things in detail. And we refer to this study as market structure because it's how the whole markets move. Okay, it's how the whole market moves. Understanding the trend can help you add other criteria to your trade qualifiers, such as volume, pivot points, moving averages, and more. Okay, so understanding market structure will help you add a lot of things to your trading process and your trading progress, which helps you better your edge when you are trading. Okay, it helps you better your edge while you are trading, so you've got nothing to worry about at all when trading. You've got nothing to worry about. Once you understand the concepts behind market structure, no worries at all. You could do amazingly well in the markets, no stress. You'd be able to understand things and be able to project price in a proper manner. Now, let's talk about the basis of market structure. Okay, let's talk about the basis of market structure. Now, market structure consists of different types of trends. Okay, market structure consists of different types of trends. Now, we have the uptrend, we have the downtrend, we have the sideways or the consolidating trend. Okay, we have the sideways or the consolidating trend. Those are the three types of trends that we have. Those are the three major types of trend that we have. Now, each trend and even the trendless sideways movements have specific characters. Every single trend, even the consolidation and the sideways movement, have specific characters. You see, to understand market structure and ultimately what a break in market structure means, you need to first have to understand what the specific sign of each trend are. Okay, what are the specific characteristics of each trend? What are they? That's what you need to understand first. That's what you need to understand first before you dive into the whole concept of market structure, breaking market structure, and the likes. Okay, that's one of the things you need to have a very good understanding of. So I just sent out a poll right now. Please do to respond to it. Now, an uptrend. Okay, an uptrend consists of higher lows and higher highs. Okay, higher lows and higher highs. As you can see on the right hand side, we have this diagrammatic expression which shows you how a uptrend is. Okay, it shows you a higher high, a higher low, a higher high, a higher low. And on the left hand side, you can see the real formation on a chart. The real formation, you can see we have higher highs and higher lows, 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 higher highs and higher lows. You can see how it forms on a real-time chart. Now that is just what an uptrend consists of: higher lows and higher highs. Now, talking about a downtrend characteristics are lower lows and lower highs. On the right hand side, also, you can see a diagrammatic expression showing you a series of lower highs and lower lows, lower highs and lower lows. Then on the left hand side, you can see a chart example, which is showing you lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. That's the chart example showing you all of these things. on a chart. Now, let's talk about the sideways markets. Okay, a consolidating market does neither of the earlier mentioned things. Okay, a consolidating market does neither, that means none of the things we've mentioned previously, until when supply and demand are out of balance, price breaks out. Now, a breakout can occur either to the upside or to the downside, depending on where price is in correlation to the overall market situation. Now, you can ask yourself a lot of things when you look at the chart. You can ask yourself a lot of things when you look at the charts. Okay, you can ask yourself a lot of things. You can ask yourself a lot of things when you look at the chart. Is what is the preceding trend? Where is price? Where is it at support or resistance? What is the overall higher time frame trend? These are one of the questions you can ask yourself when you look at the chart. You need to understand what the preceding trend is. Where is price? Is it at support or resistance? What is the overall higher time frame trend? These are questions you ask yourself. Okay? These are questions you ask yourself. Now, if you look at these diagrams, you can see a consolidation, which is a sideways movement, then a breakout is happening to the upside. You can see a consolidation, which is a sideways movement, and a breakout is happening to the downside. You can see a consolidation also down below here, and you can see a breakout is happening to the upside. Then the diagram up here explains to you properly that once we have a consolidation or a sideways movement, we can have a breakout above or below. Not difficult at all. We can have a breakout above or below. Above or below. Okay, that's how a breakout occurs. It can be above or below once you understand the components, the characteristics of a consolidation or a sideways market. Now that you've established a proper basic understanding of what trends can look like and what they consist of, it's time to move one step forward. Now we're talking about swings, okay? Swings. Okay? Swings. There are two types of swings. One, the swing guy. Two, the swing low. The swing guy, the second one is the swing low. Now, in this diagram, you see that there are some areas are marked in blue, some areas are marked in red. The areas marked in red is a swing low. The area marked in blue is a swing guy. Swing guys are above, swing lows are below. Swing guys are above, swing lows are below. Okay, swing guys are above, swing lows are below. Now you see, once you understand the idea of swing guys and swing low, you understand that swing guys means price have topped, swing lows means price have bottomed. That means whenever you see a swing guy, expect a certain reaction in price to either reverse the preceding trend. Whenever you get a swing low in price, you wait for a reaction in price to reverse the preceding trend. Now, a swing guy. A swing guy is a failure to close above a certain level and hence a sign of exhaustion for, in this case, bulls to push price further higher. Now, what this basically means is that once you see a swinger, it means price cannot go up anymore. The next thing for price to do is to go down. Okay? The next thing for price to do is to go down. Whenever price can't go up, the next thing for price to do is to go down. That's why I call it a swing guy. The highest point, the peak point in which price gets to. You see, in all situations, price fails to close above a specific level and therefore getting rejected and leading into a breakdown. That means price starts going down. The swing low. The same thing applies to a swing low, but basically it's vice versa, where bears fail to push price further lower and subsequently boost takeover control. Okay, now in all three attempts to break down and going lower on the charts, price fails to break the support level and therefore leads into a breakout to the upside. You can see how price tried to go lower. Hmm? You see, price fails to go lower. Then what happens? Price starts going higher because there was no further momentum to start going down. So price just starts going up. It is important to keep in mind, swings take place at significant level, which you must find on the left on your chart. Okay, so for you to understand swing points, you have to go back in time on your chart. I'll show you on the chart soon. You have to go back on your chart to check and see how these swing points occur and why. And why is it really important? Because these are places where a break in market structure can occur. If a low or a swing high has been violated by a candle close below or above, depending on the situation, it implies a shift or continuation of the ongoing trend. Okay, it implies that there will soon be a shift or there will soon be a continuation of the ongoing trend. A word of caution, okay, a word of caution. Higher lows in an overall downtrend mean nothing if price fails to accomplish a higher high. So if you have a higher low and there is no higher high in a downtrend, it doesn't mean anything, and vice versa also. Now, how does a break in market structure look like? Before we go into break in market structure, I want to go to the charts and show you something on the chart. Okay, I'll go to charts and show you something on the charts. I want to go into the charts and show you something. I'll share my screen right now so you can see it on the charts. Okay, you can see it on the charts. Waiting for my charts to load so I can show you on a real chart. Okay, yes, please, if you can see my screen, please let me know. Okay, if you can see my screen, please let me know. Can you see my screen? Yes or no? Can you see my screen? See my screen, please let me know. If you can see my screen, please do let me know. Also, I just sent out. Please let's do what respond to it. Okay, let's do what I just sent out. Now, let's use a chart to explain the concept of trends, swing highs, swing lows, and all. Now, we said there are three types. The uptrend, which is what we have in the downtrend, which is what we have here. The sideways trend, which is what we have here. Let's go into detail on everything. We said in an uptrend, we have series of higher highs and higher lows. Okay, higher highs, higher lows, higher highs, higher lows. Okay. That's why we say we have series of lower high and lower, 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 lower. We have series of lower highs and lower lows. Okay, lower high, lower low, lower high, lower low, lower high. Now, in a consolidating market, we said, or in a sideways market, there's no highs and there's no higher high or higher low or lower high or lower low. All we just have is highs and lows, highs and lows, highs and lows. That's what we have in a consolidating market. Now, talking about swing points, okay, this is a swing guy. This is a swing low. This is a swing guy. This is a swing low. This is a swing guy, a swing low, a swing guy, a swing low. So they are just turning points in price, turning points in price, turning points in price. That's what swing guys and swing lows are. Okay? That's basically what swing guys and swing lows are. And that's just the idea behind trying to swing guys and swing lows. Now let's go to the slide. Now, I said previously, okay, I said previously, how does a break in market structure now look like? How does a break in market structure now look like? In order to understand what a break in market structure looks like, we have to understand first what an engulfing of a level looks like and what it means. Okay? Now, there are two types of engulfings. You have the bullish engulfing and the bearish engulfing. Bullish engulfing is when the body of an up close candle completely engulfs either the body of its prior candle or a certain resistance level. This is the bullish engulfing candle here. You see, the bullish candle engulfs the previous candle completely and closes above the previous candle. While this is the bearish engulfing. A bearish engulfing is when the body of a down candle is engulfed either the body of its prior candle or a certain support level. You can see this is a bearish engulfing candle right here. The candle completely engulfs the previous candle. Candle closes below the previous candle. That's the idea. That's the idea behind engulfing candles. Now that's how market structure is being noted. Okay, I'm going to show you right now. Now, from theory to practice, the bullish engulfing candle, the up close candle only engulfs its period down candle, and it also engulfs the level where price previously fails to close above, and ultimately leading to a break of MS. Break of MS means break of market structure. Okay, the bearish engulfing candle. The down candle not only engulfs its previous candle, but also engulfs the support level from where the previous candle bounced off and closes below, ultimately leading to a break of support into resistance, better known as S&R flip. Now, let's go on the chart further. Now, let's use another chart to make this example better. Let's use this to make an example better, a better example to be precise. Now, let's look at this. Let's look at this piece of price action. Sincere apologies for the breaking connection. Sincere apologies. Let's dive right back into what we were discussing. So I wanted to show you guys a diagram on the real charts of a breaking market structure. So let's go to my charts. Please, if you can see my screen, please let me know. Okay, if you can see a chart on my screen, please do let me know. Thank you very, very much. Can everybody see a screen on my chart, please? Let me know. Can everyone see a screen on my chart? Yes or no? And also, can you hear me now? Okay, brilliant, brilliant, brilliant. Now, we said an engulfing candle is what signifies a breaking market structure. Once we've created series of highs and lows, okay, this. Where is our breaking market structure? Our breaking market structure is right here because this is where the engulfing candle came into action. So once we took out this level, we understood that we were no longer bullish, but now we are bearish. And look at what happened after that. We melted down. Okay, let's look for a bullish scenario, bearish to bullish scenario. Okay, let me pick another chart. Trying to look for a perfect example. Okay, let's use this one right there. Now look at it, we're trending lower, creating highs and lows, okay? Highs and lows, highs and lows, highs and lows. And we took out the last previous high with an engulfing candle. What happened after that? We traded higher, okay? We traded higher from there. So that's just how to like pinpoint and figure out a breaking market structure. Now that we've established the basic understanding of what engulfing means, we can move forward onto the webinar's final insights. Okay. Now, the breaking market structure, as I said previously, here is a very simplistic and theoretical approach to depict a violation of a trend and hence leading into a break in market structure at the top of an uptrend. Now look right here. You can see we have series of higher highs and higher lows, higher highs and higher lows, higher highs. Then we had a higher low. We didn't go up much. Then we broke it. That was where our breaking market structure happened. Then we started going down. Right here, you can look at right here. The up candle does not only engulf its period down candle, but it also engulfs the level where price previously failed to close above, which is ultimately leading into a break in market structure. Now, as usual, theory first, then break in market structure on the right hand side. Okay, look at this right here. Okay, we have a what? A higher low, a higher high. We broke structure. And look at it right here. Okay, we had a lower high, lower high, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Now what happened? We broke structure, the actual beginning of a breaking market structure. Then, despite price making an equal low to a higher high, could not be established. Right here, we now broke major structure right here. So we broke minor structure here and we broke major structure right here. Now, I want you to remember something, which is the trend is your friend until it isn't your friend. You can use the trend to your advantage because, unlike traditional investing, money can be made both ways. Once you use the trend and market structure to your own advantage, money can be made both ways. Money will be made both ways. So you can easier spot the shift of a trend and hence change your directional bias quicker this way if you want to pay attention to what the market is telling you. You must remember to backtest any approach first by demo trading. Now let's go to the charts more before we bring the webinar to an end. Just from looking at the charts, you can see there is also continued breaking market structure, which means price will continue to trade in that certain direction, right? You have it right there also. Like every single time. You can see right here, every single time it happens, it occurs. So basically, it's nothing to worry about. It's very, very simple and easy to implement on a real-time chart. Okay. So we've come to the end of today's webinar. Thank you for attending today's webinar. I'm your host, Akinwale Chibike, and I'm open to taking questions. Okay.